Hello everyone. Have you ever wondered, always we talked about the MSCI index rebalancing, but most news channels and even we also have not talked about the Nifty or Bank Nifty rebalancing. In fact, coming September 2024, in the Nifty index, HDFC Bank weightage is going to drop from present 13% to around 11%, and in the Bank Nifty wise, at present it's near the sector's max cap 32%, but after 2 months it's going to drop to around 28%. Why? So from the Indian market perspective, isn't a big thing? Shouldn't our market react more for the Nifty and Bank Nifty rebalancing? Why aren't they? Why Infosys weightage in Nifty 50 is higher than TCS, and why HDFC Bank has higher weightage than Reliance? All those we are going to discuss in detail in this video. First, how the stock weightage is calculated, and then which index like Nifty or MSCI, how much it influences in our Indian market. To be honest, when I was researching this topic, I personally felt this is the most important topic that all the traders should know. And I hope personally that you would feel the same way when we completed the video. So without delay, let's get started. For any NSE index, there is a fact sheet in the NSE India website. For Nifty and Bank Nifty, I will attach the link in the description below. In that, they will mention the secondary eligible criteria for the stock in that particular index. For example, here these three are the secondary eligible criteria for Nifty 50 stocks. First, for 90% of the time in the last 6 months, every day the stock has to have trade for at least 10 crore rupees with the impact cost of 0.5% or less. Here in the last week's Saturday video, we discussed about how we calculate the impact cost. Hope you guys remember that. Then second, the stock should be listed and traded in the F&O. And finally, the company should have minimum listing history for 1 month. So these are the secondary criteria, and the primary criteria for the stock selection is it should be part of Nifty 100 big ones. Hence, now we selected 50 stocks. How they are defining the weightage? For that, we need to understand the concept of free float market capitalization. Let's go to the Reliance Industries NSE India website stock page. Here, the total market cap of Reliance is around 20 lakh crore rupees. In the same page, then second to that, it itself mentioned that the free float market cap is 10 lakh crore rupees. What does it mean? Basically, it means how much stock worth in the market cap that investors can trade in the open market. Market cap minus promoter holdings, government holding, employee holding, and in addition like private equity holding, etc. That difference will give the free float market cap value. 50% of Reliance Industries is owned by promoter related persons, whereas the remaining 50% is available for trading. Likewise, we need to find the free float market cap of each of the 50 stocks in the Nifty index. Then adding all those 50 stocks free float market cap value will give the Nifty index total free float market cap value. Here I compiled it for all the Nifty 50, which I will attach in the Excel link in the description. Basically, if we add all together, then the Nifty index total free float market cap will come around 110 lakh crore rupees. In that, the stock weightage is how much percentage it has. For example, in Reliance free float market cap is 10.1 lakh crore rupees. So 10.1 divided by 110, which comes around 9.2%. Hence, that 9.2% is the Reliance Industries single day stock weightage in Nifty 50. It's just a stock free float percentage in the total index free float. The rebalancing cutoff date for Nifty is always the last day of January and last day of July. We already know the single day weightage. Then taking the average of those 6 months single day weightage before the cutoff date is the weightage of that particular stock in the index. Here, the implementation date is every year last day of March and September. And the index rebalancing review will be 4 weeks before the implementation date, ideally last day of February and August. If required, please pause and have a look. These are the important dates related to Nifty or Bank Nifty or Fin Nifty index rebalancing. Now coming to the question, why Infosys has higher weightage than TCS, though TCS is twice the big company as Infosys? Because in TCS, the promoter holds over 70% of the stocks and the free float is only around 28%, Whereas in the Infosys case, the promoter holds only 14%, the remaining 86% is free float. Hence, the free float market cap of Infosys is higher, 6.7 lakh crore rupees, whereas the free float market cap of TCS is just 4.47 lakh crore rupees. Hence, only based on the free float market, always in most index, Infosys is having higher weightage than TCS. Similarly, in HDFC Bank case as well, Reliance got the free float of 50%, whereas HDFC Bank got the free float of 99%. Hope everyone can follow me. And the MSCI index also follows the same exact logic. The only change is they use the free float market cap available for the foreign holdings, for which they use the factor to determine. And they rebalance every quarter, whereas for NSE, they rebalance every 6 months. I mean, all fascinating, the calculation, etc. So what? The very important takeaway here is, if the stock price increases relative to other stocks in the given index means, then its weightage will increase in the rebalancing. If the weightage increases means, then that will bring more index fund into that particular stock. Then the more fund into the stock will further increase the price, then that price increase again will increase the weightage. Basically, it's a cycle. And the same applies for the stock that decrease, but on the weightage downside until the cycle breaks down. So in the normal economy, the stock which increasing will keep on increase because the demand for the stock increases as the index weightage increases means. Now to our final important question. Why the market react to MSCI index rebalancing but not for Nifty or Bank Nifty rebalancing? The answer for that is, it's just the amount of fund they have. I mean, MSCI has hundreds of indexes. In that MSCI All World Index is the main one, where the majority of the ETF, pension funds from US, UK, Germany, etc. and sovereign funds like Canada, Singapore, etc. all invested their money. The total amount that invested in the MSCI All World Index is roughly 4 trillion US dollars, which is the second highest in the world. Just for info, first is S&P 500, roughly near 5.5 trillion US dollars. Then in the MSCI indexes, the second biggest is MSCI Emerging Market Index, approximately 1.6 trillion US dollars worth of fund in it. Here, please have a look at this graph. As per Reuters.com, as per last week MSCI index rebalancing, the share of Indian stocks in the MSCI Emerging Index increased almost to 20% from earlier 10%, which means roughly 320 billion US dollars worth of MSCI Emerging Index related funds is in the Indian market. So the important thing here is, because the Indian stocks inside the MSCI Emerging Index is increasing in the last 1 to 2 years, which in turn at the expense of China is bringing more weightage into the Indian stocks. Please note, this is one index, MSCI Emerging Market. Similarly, there is an India-specific MSCI index which got fund invested for around 80 billion US dollars. So, considering all the MSCI India-related index, the fund should be worth somewhere between 400 to 450 billion US dollars, which is roughly 40% of all the FII invested money. In comparison, NSE Nifty, Bank Nifty and Fin Nifty all together has the fund of only around 50 billion US dollars. So the MSCI India related investment from MSCI indices is 9 to 10 times higher than NSE related funds invested in the stocks. Here, please don't confuse with the daily trade value or the volume, that is different. Hence only always stock market react for the MSCI index rebalancing but not for Nifty or Bank Nifty rebalancing. So as long as Indian stocks value increase higher relative than Chinese market, as a consequence in the MSCI Emerging Market Index, the Indian stock weightage will increase and the cycle starts, which in turn increases the demand for the Indian stocks unless cycle stopped by poor economy or poor bad results, etc. Here you might ask, poor bad results, okay, will reduce the stock demand, but why poor economy? The reason is, if it's a poor economy in US or UK or Germany, etc. means exchange traded funds won't receive fresh money from the people, and also the fund manager will liquidate their index fund for giving back to their investor in case they want the money. So that's how today our world is functioning. Good economy, more money to exchange traded funds, and the vicious cycle of rich stocks will get richer. Here, please note, I'm not saying costly stocks becomes costlier. The reason for that is when the stock price increases means then that company can borrow more money, which again they can invest and grow faster. So it's rich gets richer is the correct statement. I mean, I constantly hear from people that Nifty is expensive, etc. But the takeaway is there is a demand increase as well. So my point is, as long as MSCI India related stocks percentage increases, which will bring more money into the Indian stocks unless the cycle is broken for one or the other reason, and the Indian stocks will get rich and richer. And in addition, SIP money as well, which is another separate big thing. Here, some might argue then how FII sold 1 lakh crore rupees worth of share etc. in the 6 months. There is an answer in the video itself but not straightforward. Hopefully, I will make one more video about it since this video itself became very long. So that's all in this video. Hope you all got some useful information. Please consider subscribing to the channel and liking the video so it will help me beat the YouTube algorithm and also motivate me to do more. Please don't make any investment decision based on this as I'm not a SEBI registered advisor. I'm doing this for me and viewers educational purpose only. Thanks for watching.